Business development companies outperformed the S&P 500 in early 2025, but more recently, this chart looks like an alligator opening its mouth. BDCs offer a median yield of more than 13%, but this recent price decline has investors wondering if there's something wrong. Today, we'll look at why BDC prices slumped, the risks facing BDCs, and whether it's time to jump ship. Why would anybody want to invest in something that goes down when the S&P 500 is going up? The obvious answer is the income. That 13% yield I mentioned earlier is huge. A couple of important things to qualify here. Number one, BDCs are structured as regulated investment companies, which means they receive favorable tax treatment in exchange for distributing at least 90% of their net investment income. So typically, they deliver most of their returns as income, not appreciation. For that reason, you can't just look at price charts and ignore the income because that's where most of the returns are. Number two is that not all BDCs make great investments. That 13% median yield includes some BDCs that I would argue are too risky. Most of the BDCs I like pay a little less than 13%, but still a pretty decent yield. If we zoom out to the long term, BDCs make more sense. Here's a total return chart that includes changes in price and also accounts for the income. This is the biggest BDC by market cap, Ares Capital or ARCC. It's almost double the size of the second biggest BDC. Long-term performance since it went public in 2004 is excellent, and the recent dip barely even moves the needle. The price has been volatile at times, but the income has been quite consistent over the past 20 years. The yield is currently just under 10%, and I've been happy with it as a long-term income investment. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. And if you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description. It's free. Okay, let's return to 2025 and the recent price drop. Markets are sometimes irrational, but my understanding of the recent negativity boils down to three key reasons. Number one is the Fed cutting rates, or to be more accurate, the expectation of future cuts, because we've only had one 25 basis point cut so far in 2025 as I record this. Interest rates matter because BDCs typically lend to the majority of their customers at floating rates. Eventually, the BDCs will also pay less interest on their borrowings, but over the short term, a Fed rate cut reduces their spread between what they pay and what they earn. Here's an example. Main Street Capital is a high-quality BDC. Here's their 2025 Q2 income statement summary. Distributable net investment income is $1.06. They paid out regular dividends of 75 cents, plus supplemental dividends of 30 cents per share, for a total of $1.05, almost the entire $1.06. Meanwhile, their net asset value grew from $32.03 up to $32.30. So lots of income for investors and a little bit of growth as well. Their estimated impact of a 25 basis point Fed funds rate cut is 4 cents per share per year. Going back to our quarterly numbers, 4 cents per year divided by 4 quarters is 1 cent. A 1 cent reduction in investment income would reduce distributions by roughly 1% for the quarter. Not exactly dramatic. For some context, here's the full history of Maine's regular dividends shown in gray and supplemental dividends shown in green. The supplementals were paused during the Great Financial Crisis, no surprise there, and the COVID crash, and the regular dividends, though, unaffected. Reason number two for the recent BDC price dip is reaction to the bankruptcy of the auto parts company First Brands. Of the roughly 50 publicly traded BDCs, my research showed me that the bankruptcy affected primarily 3 BDCs, PSEC, PSBD, and GECC. I only follow the major BDCs, and I'm not familiar with those 3. Some private BDCs were also affected, but I don't follow those either. The only name I'm familiar with that has been mentioned in relation to First Brands is FSCO. However, they're a closed-end fund, not a BDC, but they do some BDC-style private loans. First Brands was about 1.5% of their portfolio as of June 31st, 2025. On October 13th, they filed an 8K with the SEC to disclose they have no exposure to First Brands. Now, I was unable to find out what transpired between June, when they did hold the loan, and September, when First Brands went BK. So maybe they had a small amount of exposure. It's unclear so far. Reason number 3 popped up while I was preparing this episode. Regional bank problems. 2 regional banks, Zions and Western Alliance, announced issues with a total of 3 borrowers. No surprise that their stocks fell, but so did other bank stocks, and so did BDCs. A BDC isn't a bank, but they often get tarred with the same brush. Remember March 2023 when the 3S banks collapsed? Silicon Valley Bank, Silvergate Bank, and Signature Bank. BDCs took a hit back then too. Here's Ares Capital again. No treasury collateral issues like Silicon Bank, no crypto issues like the other 2 banks, but the price was hit all the same. It turned out to be a good time to buy ARCC. So that's a lot of numbers and information. Here's my take. Each time the Fed cuts rates by 0.25%, it has a very small effect on BDC distributions. The market is either overreacting or expecting massive cuts in the future. And then the First Brands bankruptcy has 0 effect on the portfolios of any of the major BDCs, so the market may be concerned that it's a sign of bankruptcies to come. In other words, the market isn't so much reacting to what happened, but rather what might happen in the future. Let's look at the specific concerns for BDC investors, starting with price. As we saw earlier, the price of BDCs as measured by the BSD ETF, which tracks the MBIS US Business Development Companies Index, is down 15.6% for the past year. So what if it just keeps going down, down, down? Well, that's possible. It's only up 17% over the past 5 years, and it's down almost 15% over the past 10 years, which means it was flat for 10 years until this recent dip. The bigger concern for income investors would be the income. What if it gets slashed? An example would be if investors think the Fed is going to sharpen their Ginsu knives and cut like crazy. As I record this, the Fed funds rate is 4.1%. Let's assume the Fed goes all Edward Scissorhands and does 16 25 basis point cuts. In other words, a cut from 4.1% down to 0.1%, which is where it was in 2021. The total distributions from BSD for the past year totaled $1.71. The total distributions from BSD back in 2021, when the Fed rate was close to zero, $1.40. That's a difference of 18%. Now, most people don't expect zero rates again anytime soon, but it has happened before, and BDCs still distributed a reasonable amount of income, which is more than I can say for some banks who have a history of cutting their distributions by a lot more than 18%. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. The BSD numbers provide a sector-wide snapshot, but BSD passively follows a BDC index, and frankly, you can do better than that. PBDC is an actively managed fund that was launched in 2022. Active means they can be more selective, which explains the outperformance by more than 10%. This was discussed in more detail in a recent interview with PBDC's fund manager, Mike Petro. Another option is to focus on individual BDCs that have a history of doing what you want. ARCC didn't cut their regular dividend in 2021 when rates were basically zero. Maine didn't cut their regular dividend in 2021, and HTGC didn't cut their regular dividend in 2021. If I was looking to buy individual BDCs for the first time, ARCC would be on my shortlist. I continue to hold it. My last review was back in July of 2025, but you can get a more recent analysis from JR Research on Seeking Alpha. Their September article dives into the effect of rate cuts on ARCC specifically, and the spillover income ARCC has up its sleeve to cover any shortfalls. I don't buy or sell anything without first checking Seeking Alpha. It's my primary source for all income investing. Link in the description for a free trial and a discount. So we've been focusing on what could go wrong, but it's also worth remembering that rate cuts aren't all bad. Lower interest makes loan repayments cheaper. So all other things being equal, that means lower defaults. Lower interest rates will encourage borrowers to refinance. BDCs earn fees from those refinancing transactions. Lower interest rates stimulate growth in the economy and are generally good for equities. Unlike banks, BDCs can take equity positions in the businesses they lend to. If those positions rise in value, the BDC realizes a higher gain for itself. And last of all, lower interest rates increase the demand for loans. As loan volume increases, the lender has more leverage to negotiate favorable loan terms. Now, before we get into my reaction to all this BDC turmoil, I've found the emails from ADS Analytics particularly helpful recently. If you want to go really deep into BDCs and also preferred shares, they have a service that provides daily market updates. This email they sent last week about BDCs was more technical than I am in these videos, but very helpful. Link in the description for an Armchair discount if you want to check them out. Price alone doesn't tell us the whole story, but if we focus on it for just a moment, I'd actually be more inclined to sell if the price went unusually high rather than unusually low. BDCs were in a sweet spot for a little while because we had high interest rates, but no recession. That meant above average revenue, but no spike in defaults. This led to higher than usual special dividends. That temporary sugar rush is now pretty much over, and BDC prices and distributions are returning to a more typical pattern. I don't see that as a crisis or a reason to dump BDCs. If price volatility makes you stressed or you need your investments to rise in value every single quarter, then maybe BDCs aren't for you. If you believe that quality BDCs are capable of consistently lending out at rates that are higher than their cost of capital and lending to businesses that can pay back their loans, then it's a way to generate a yield of at least 8%. My reaction to the recent BDC price correction is not much, because I already have a decent allocation to BDCs and I don't want to be overweight in them. For example, I maintain a 5% allocation to PBDC and it's dropped down to 4.91% as I record this. If the price goes below $29, then I'd top it back up to 5%. I understand the urge to react to news by making a trade, doing something dramatic, but unless there's a fundamental shift that would cause the future income to be insufficient, I try not to react with dramatic moves. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, click here for reviews focused on my top 10 holdings. That wraps it up for this look at BDC turmoil. More Armchair Income coming soon.
Armchair Income.